Hello everyone, this is Mark with Semantics Research with a video on sector performance in business cycles. It is quite important to understand for an investor how there must be different investment approaches during business cycles. Economic cycles tend to impact sectors quite differently, as it is crucial to identify sectors that are favored by the present business cycle. Understanding performance during these cycles help investors identify opportunities as well as risks. With this in mind, it helps investors evaluate and adjust their exposure across different investments. There are 10 different economic indicators used in the LEI index, which has been created by the Conference Board, which is indicative of turning point patterns in economic data. It ranges from unemployment to business orders to financial conditions and consumer expectations. The 10 components of the Consumer Board leading economic index include average weekly hours in manufacturing, average weekly initial claims for unemployment insurance, manufacturing new orders, consumer goods and materials, ISM registered index of the new orders, manufacturers, new orders, non-defense, capital goods excluding aircraft orders, building permits, such as new private housing units, stock prices, 500 common stocks, leading credit index, the interest rate spread, such as the 10-year Treasury bonds versus the federal funds rate, and the average consumer expectations for business conditions. Now, as we can see, the business cycle is shown to be divided by the direction and magnitude of changes in the Consumer Board's LEI index. As you can see, it's all color-coded. Nice and pretty, and it highlights different parts of the business cycle: going in recession, recovery, expansion, and slowdown. So there are 4 stages in the business cycle. One being recession is when economic activities fall significantly across the board, with declining economic outputs and aggregate demand from businesses and consumers falling. It also includes increasing unemployment, low consumer confidence, contractionary domestic production, and generally the Fed attempts to increase aggregate demand by lowering rates and increasing the money supply. In a recovery stage, it's when the economy rebounds sharply from the bottom, but it is below trend. The GDP growth and aggregate demand accelerates, and consumer sentiment goes more positive as the consumer takes advantage of low interest rates and increased discretionary spending, while businesses cut back on commercial activities. Expansion phase is when economic growth reaches a cycle peak and there's rosy economic prospects as well as increasing corporate profits. We see companies begin to allocate capital to expand business and improve production to meet increasing demand, and interest rates rise from low levels at this point. In a slowdown, we tend to see capacity utilization reach cycle peak and economic outputs gap churn positive, meaning the economy is running beyond sustainable means, and due to limited capacity constraints, economic growth from accelerating leading to positive growth, but at a decelerating rate. Monetary policy also becomes restrictive, and it steers the economy from overheating. During a recession or a late cycle, we see non-cyclical sectors like consumer staples, utilities, and healthcare perform well as their business is non-discretionary and less sensitive to economic fluctuation, while we see real estate and technology are the worst performing sectors across all metrics, as their sectors are the first to experience spending cuts during periods of falling income and business activities. Now, if we take a look, in a recession or early cycle, you tend to see improvements in labor markets and consumer confidence, which leads to increases in discretionary spending on restaurants, travel, and durable goods, which benefits consumer discretionary sectors. With low interest rates and easing monetary policy, it does make it cheaper and easier to purchase real estate, which leads to real estate sector outperforming other sectors. And consumer staples, utilities, and healthcare tends to lag the other sectors at this point as investors rotate into more cyclical sectors. They're in a recovery phase. Or early cycle, you tend to see improvements in labor markets and consumer confidence, which leads to increases in discretionary spending on restaurants, travel, durable goods, which benefit consumer discretionary sectors. With low interest rates and easing monetary policy, it makes it cheaper and easier to purchase real estate, which leads to real estate outperforming other sectors. Consumer staples, utilities, and healthcare tends to lag other sectors at this point as investors rotate into more cyclical sectors. And during the expansion phase or the mid-cycle, we see a narrow sector dispersion as economic growth accelerates to the peak and more firms benefit from the boom. Market returns are at their second best during the phase behind the recovery phase, but something to note is that this phase tends to last longer. And during the phase, capacity utilization tends to increase significantly to its peak, and businesses feel more confident and start expanding. You tend to see allocation of capital to improve productivity and more risk capital. And with that, technology tends to perform very well. And we also see interest rates start to move up, as well as loan volume from very low levels, which benefit financials. In a slowdown or late cycle, we see economic growth decelerate and input costs increase, which brings corporate profitability down, and growth comes under pressure, which remains positive, but it slows down at its growth rate. With capacity constraints, companies spend more on capex to meet demand, and there is a lag between deployment of capex and productivity. Sorry, I mean gap, not lag. Anyways, this is when the market return is at its second worst as well, as investors begin positioning more defensively and reducing their allocation to economically sensitive sectors in anticipation of the next economic downturn. You tend to see industrials perform relatively well due to investment in capex. Healthcare and consumer staples perform well, while discretionary and real estate underperform. Materials and energy are generally expected to perform well during a slowdown, but since 1980, since that the market has been becoming more, these markets have been becoming more integrated with global markets due to globalization, we tend to see less of this frequently. Now, as we deviate from the equities markets only, we can observe performance across all assets classes during each phase. Do note that not all investments perform uniformly during a cycle, as some stocks or bonds can outperform while others underperform. During the early cycle, we see that stocks benefit more than bonds and cash at this point. And during the mid-cycle, we see that bonds and cash are still underperforming, but the stock's absolute return generally was lower than the early cycle, and in the late cycle, we see that certain sectors do perform well and cash outperforms bonds. In the recession, which is the shortest phase of the cycle, stocks generally perform the worst, with bonds outperforming, as well as cash performing relatively well. And with that being said, that is it for today. Be sure to like and subscribe if you like the video, and be sure to check out the links in the description if you want to keep updated with any new further developments. Thank you all for watching, and this is Mark signing out.